Oh, sorry. Okay. Good evening, everyone. Sorry, just now I didn't press the unmute button. Okay. Okay. Thank you for tuning in today. Today I'll be sharing on the basics of CFD. Okay. Let me do some self-introduction before I start the webinar. I'm Daryl, and I have been with Phillips for around 2 years now. Okay. If you have been tuning into our past webinars, right, you probably have seen me or heard me before. So if you do not know me, right, I'm the night CFD dealer. So if you happen to call in the night, right, you'll probably recognize my voice. Okay. So prior to joining Philips, right, I have helped many families with generating wealth. So I hope that today I'll be able to share with you some of my knowledge, and it will be better if you are able to learn something out of it, and hope you enjoy the webinar. Along the way, if you have any questions, right, feel free to write your questions in the chat box below. I'll be replying to some of those questions, right, during the Q&A session towards the end of the webinar. Just like every other educational videos or webinar, right, there will be a need for a disclaimer. So this is my disclaimer. This presentation today is intended for general circulation only. Everything discussed today, right, are all opinion. Okay. Please do your own research before investing. Should you need any advice, right, kindly consult a financial advisor or contact your TR. So this is the content for today. I'll be sharing on CFD, which also means contract for differences, and also the types of CFD instruments and how people leverage on them and trade CFD. With that being said, right, today my webinar will be to learn the basic of CFD. Okay, so what is investing? Why do people invest? Okay, so when we talk about investing, right, we'll definitely want to earn some money. Okay, so the golden question is, right, how can we earn money from investing? So it's primarily based on two different factors. Okay, so the first one is called the dividend, and the second one is also capital appreciation. Maybe I can give you a simple example of investing using an apple tree as an example. Investing, right, is like buying or growing an apple tree. Okay, when I buy this tree, right, I invest in this apple tree. So when the tree grow, there will be apple. So I can either eat this apple for survival, right, or I can sell them in the market to earn some money. So this apple we get from the tree, right, is like our dividend. So depending on the stock you invest, right, from time to time, the stock will give us dividend. So after some time, right, I decided that I do not want to continue growing this tree already. Okay, by then the tree will get older and probably be producing more apples and worth some money. This is when I will sell this tree to someone, and the tree will probably be worth more than my initial purchase. So this is why people invest such that they can grow their money. So there are two types of market condition. So in the stock market, right, there's two types of movement. Okay, first one being the upward movement, the second one being the downward movement. So when it's going up, right, we call it bullish in the bull market. So when you hear people saying that the market is very bullish, right, this means that the market is in an upwards trend. However, when you hear people However, when the market is going down, right, we call it bearish. So when you hear people say the market is very bearish, means the market is on a downwards trend. So in a bullish situation, right, when we want to long the stock, right, it also means that we want to buy the stock. So in order for us to profit, right, the stock must go up. So in order to buy the stock, right, we must look at the ask price. Likewise, when we want to sell the stock, right, or short the stock, okay, for us to profit, right, the stock must go down. So this is when we look at the bid price. So if you have used our platform before, right, you have seen the bid ask pricing. So you can see on the bottom right of this slide, right? To buy, we must look at the ask price, which is the green box. To sell, we must look at the bid price, which is the red box. So what is CFD? CFD, which also means that contract for differences, okay? CFD is a derivative product, which also means having a value derived from another underlying assets, Okay, CFD is traded over the counter, traded via a broker-dealer network, which in this case, right, if you trade with us, is traded under Phillips. One advantage of CFD is that you will be able to buy or sell, which means that you will be able to profit at both bullish and bearish situation. This is then again depending on the type of strategy you want to use. When you long or hold one stock, right, one stock contract, okay, you do not own the underlying assets, but what you're getting, right, is actually a contract. CFD is a contractual agreement between an investor and a CFD broker to exchange the differences in the value of a financial product between the time of the contract open and the time when the contract is closed. Okay, so different country equities have different market hours. So if you hold past the opening hours, you hold past the closing hours, right, then there will be a financing charge, which you can find out more about it later. Later, I will explain more about it. So what's the difference between stocks and CFD? One key advantage of CFD have against stocks is that we have this thing called leverage, which means you can use lesser margin to gain higher exposure, which we will discuss again. We will discuss later more about it. Okay, CFD allows you to go long or short, which means you'll be able to profit from both bullish and bearish market. However, for stocks, right, if you're using our platform, you will only be able to short or leverage, right, if you are using a margin account and have a SPL account. Okay, the interest is the same if you're using a margin account to trade. But unlike CFD, right, you will be only using one account and be able to leverage and short and also tap into different assets class, which is more convenient for you. Okay, there are also finance charges applies when you hold a CFD overnight. Do note that when we purchase a stock, right, we own the stock. However, for CFD, right, it's just a contract. You do not own the underlying stock. Okay, so this is just a brief advantage of CFD, which I'll explain more in depth later on. Okay, like what I said before, okay, we are able to long or short. When we think that the stock will go up, we can buy. When we think the stock is going down, then we can short the stock. We are not restricted by any market directions, and we can profit from both rising and falling market. And there's this thing leverage, and also multiple asset classes like FX, indices, equities, CFDs, and commodities. And ultimately, hedging. So hedge is like buying an insurance in the event of news, especially those bad news, right? Your portfolio will be protected. So we can hedge our portfolio against the news, which then again, I will discuss more about it later. Okay, so using an example of S&P 500, right, to explain how we can trade two direction using CFD, right? Okay, you can see based on this slide, okay, when we think that the market is going up, we can long at the bottom and take profit at the top or wherever we think that is the highest. However, if we anticipate that the market is starting to fall, right, then we can immediately short the market. Okay, we are not restricted by any market directions, and we can profit from both rising and falling market. By now, we should already know that CFD is traded on margin. Okay, using the power of leveraging, right, we are able to take on larger positions using lesser initial deposits. With leverage, right, we can amplify our gains. However, leverage is a double-edged sword. We can also lose a lot. We can lose a lot more, right, if the market goes against you. One reason why people use leverage is because, right, we do not have large amount of money to diversify our portfolio or gain exposure. So we tap on CFD, right, to gain the exposure. So let us compare, right, the difference in terms of money. Okay, let's say we want to long 100 company ABC, right, at $100. And for this counter, right, the initial margin required is 10%. So for stocks, right, in order for us to hold 100 shares, right, at $100, right, you will need about 10K. However, using leverage with CFD, right, we will only need $1,000. So using this $1,000, right, we'll be able to gain exposure of this $10,000 contract value. So how can we amplify our gains or loss? Okay, so for gains, right, if the stock goes up to $150, right, we will be profiting $50 per share. So for stocks, we'll be up by $5,000, and that will be a 50% gain. For CFD, we will be profiting the same thing, but 5,000, we are actually up about 500% because we are using a 1K to profit $5,000. Wouldn't it be great, right, to be profiting 500%, or rather gaining 500%? Okay, so let us now share about the bearish side lah. Okay, when the market goes against you. Okay, so same thing. Okay, company ABC, right, went down to $10, went down by $10, so we'll be losing $10 per share. So for stocks, right, we'll be down by 1K, which is 10%. However, for CFD, right, we'll be down by 1K, which is 100%. So this is why leverage is a double-edged sword. Okay, they can amplify your gains and also magnify your losses. Okay, so using our platform, right, using Apple as an example. Okay, let's say we want to long 100 Apple at $150. So when you launch the order ticket, you'll be able to see the gross contract value, margin requirement, and the long short financing charge. Over here, right, we can see that the margin requirement, right, is actually 10%, which also means that in order for us to hold or to buy 100 Apple contract, right, we will need around $2,000 SGD of the margin to purchase the contract that worth around 14,000. From this ticket, right, you'll be able to see the long and short financing charges. Do note that different counter have different margin requirement and financing charge. Do make sure you check, right, before you place an order. Okay, so there are different types of CFD instruments out there. Okay, so what we offer, right, is equities, where we offer CFD and CFD DMA. We also have commodities, which are mainly oil, gold, and silver. Indices like S&P 500, US Tech, Wall Street Index, and many more. There are even mini contracts for it. And also we have Forex. So let us start with equity CFD. So for our equity CFD, right, we have access to 8 different global stocks exchange. And these 8 different global stocks exchange, these are the 8 different stocks, global stocks exchange. Do note that, right, each country have their own operating hours, and then when the operating hours is over, right, then you will not be able to buy or sell, which you are not able to trade lah, which you can find out more in our website. Okay, so if you use our platform before, right, when you search a counter like DBS, Singtel, SIA, you'll probably seen this. Okay, so the blue one, right, is meant for equity, which is EQ, which is your stocks lah. Okay, so the green one, right, is named as CFD, which is CFD, which is a derivative of the stock. However, right, the darker green, which is CFD DMA, right, that's DMA. Do note that DMA, right, is only for some Singapore counters. So a lot of time, right, some customers will call me and asking me things like, how come I cannot sell my DBS? How come I cannot close my CFD positions? It's because, right, we click on the wrong symbol. Okay, one is equity, one is CFD, and the others is DMA. So these are different. So equities is equity, CFD is CFD, DMA is DMA. So before you long or short, right, make sure you click on the right logo before proceeding lah. So for equity CFD, right, these are cash settlement. Okay, it mirrors the price movement of the stocks. From this photo, we can see that there is no additional spread. Okay, we can see that the DBS bid and ask, right, for stocks, CFD, and okay, so basically they are all the same. There's no additional spread. Okay, When you search a SGX counter, right, you may see CFD DMA. Okay, DMA means that it's a direct market access, which is only applicable for SGX counters. Okay, the counter will be filled on the extra exchange and will participate in the exchange order book, which works very similar to stocks. We'll send the order to the exchange, and do note that, right, this is then based on the last done price, not the bid ask price. Okay, at this point in time, right, you'll be thinking that DMA is actually better since it provides transparency and we'll be able to monitor it via the exchange. Yes, it is better, but for the transparency, right, we actually have to pay a higher commission rate. Okay, do note that if you are trading CFD DMA, right, in order to locate them, right, you have to click on the CFD DMA, like the photo shown. Okay, so this is the summarized version of how a CFD and a DMA works. Okay, where for DMA, right, you route your order to the exchange, and execution is done on the exchange, which is traded on the market liquidity, and the order book of the exchange will give the investors full transparency. This will be reflected on the exchange just like stock lah. Thus, because of this transparency, right, you must pay more commission fees lah. Okay. However, for CFD, right, you'll be enjoying a lower commission rate. Okay. The order may or may not reflect on the exchange, and your order will be filled based on the bid ask price. You can read up more on our website. Okay, so how can we calculate the profit? Assuming we want to long 10K shares of stock A lah, okay, at $2. So since we are in a long position, right, we want the stock to go up for us to profit. So if it goes up to $3, right, we'll be profiting $10,000. And if it goes down to $1, right, we have a loss of $10,000. Basically, the difference between the price entered and the exited price multiplied by the quantities. You can see the formula on the screen lah. Likewise, if we are in a short position, right, in order for us to profit, right, the stock must go down. So using the same example, right, where it goes down to $1, we'll be profiting $10,000. When it goes up to $3, right, we'll have a loss of $10,000. Literally the opposite of long. Okay, so what is commodities? Do you know that commodities are part of our everyday life? And they are actually like the raw materials, right, we use in our daily life. To help you better understand the meaning of commodities, right, let us dive deeper into this girl in the photo lah. So what she's wearing, right, okay, her clothes, right, is actually made up of cotton, which is also a commodities. And where she can get them, right, okay, she will go like online shopping, like for example, Taobao, Shopee, which also require delivery. And this delivery, right, also requires oil, which is also a commodities. So what is she holding, right? She's holding a cup of coffee, which is also another commodities. So girl being girl, right, she like to dress up. So she'll buy those jewelries, gold, silver, which is also another commodities. So when she goes shopping, right, she will either drive or take a public transport. Okay, so this transport, right, is also operated by oil, which is also a commodities. So in short, right, commodities are categorized in 3 different sectors: metal, energy, and agriculture. So metal are like our gold and silver. Energy are like our oil and gases. Agriculture are like crops and livestock that have been raised and harvest to provide food. So in our platform, right, we do allow you to trade commodities, and the frequently traded are gold, silver, oil, and there are no expiry, and the margin is as low as 20%. And we also provide the mini contracts. Okay, so if you remember earlier on, right, how you'll be able to see the margin requirement. Okay, so we'll use the same method, right, to find out the difference between USD1 and USD100, the mini contract lah. Okay, so for USD1, right, the value per point is $1. So if let's say you're in the long position, right, okay, the USD1 goes up by $10, you'll be profiting $10. Unlike the USD 100, right? The value per point is $100. So if it goes up by $10, right, you'll be profiting $1,000. Assuming we want to long go at 1.9K lah, okay, we can see that the contract value between both, right, is different. One, right, is 1.9K, and the others, right, is the 100 one, right, is 190K. So if we do some math, right, we divide the Gold USD 100 by 100, right, we will get the same as Gold USD 1. So the good thing about the mini contract, the USD one, is that it requires lesser margin for traders, right, who wish to gain exposure, but they have lesser capital. Okay, so this is the meaning for mini contracts. So what is index? This is the method, right, to track the performance of a group assets, or rather a method to measure the performance of a basket of securities. Okay, let's use an example of STI, Straits Times Index. So STI is a market capitalization weighted index that tracks the performance of the top 30 companies listed on SGX. So currently there are around 600 over listed companies in SGX, but STI, right, only tracks the top 30 companies. Okay, so all these 30 companies, right, roll up into one easy to read average price. So if you hear people saying that the market is up, highly likely, right, they are referring to STI is up, not because STI is the market, but the index is a representative chunk of the market. Okay, because they have the largest and most influential company, right, or rather the big cap companies in Singapore, as long as you come Singapore before, or you stayed Singapore long enough, right, okay, you probably have heard of these 30 companies inside STI. If I were to name a few companies, right, they are like the DBS, OCBC, UOB, our big three local banks. Okay, let's say you see STI doing well, right, then probably you know that Singapore economy, right, is likely to be okay, doing well. Okay, however, do note that, right, if you see these bigger cap companies, right, not doing so well, right, then highly likely, right, the chances of the smaller cap companies, right, to outperform is slimmer because they are more volatile. Okay, so in our platform, right, these are the indices that we offer. Definitely more, but these are the commonly traded ones lah. Okay, you can view them. You can view more in our website. Okay, we also have the mini contracts for some of them. Okay, same as the gold example. For this, we are using the S&P 500 contract. Okay, we have USD1 and USD5. Okay, USD1, which means that the value per index point is $1, and 5 being the value per index point is $5. Okay, then again, the purpose of using a smaller contract like USD1, right, is for traders who wish to diversify their portfolio or gain exposure, but they have lesser capital lah. Do note that for our contracts, right, it tracks the performance of the cash index and dividend, and it is dividend adjustment. Okay, and the prices may differ from the cash index. Different indices, right, have different leverage. So we offer up to 20 times leverage. So if you read our website, right, you'll probably seen this. Okay, so how do you read it? Okay, using an example of STI, right, okay, we can see that the value per point is $5. Essentially, right, what we are trying to say is if STI goes up by $1, we'll be profiting $5. If STI goes down by $1, we'll be in loss of $5. Okay, and the target spread is 3.6. Okay, which you can refer to the bottom portion. Okay, assuming STI, right, is currently at $3,000. Okay, the bid is 2998.2 and the ask will be 3001.8. Okay, the difference if you add up, right, is 3.6 lah. However, I would like to draw your attention to the target spread. Okay, in the event of a volatile market condition, right, the target spread may increase. Also, the initial margin which means the amount needed to buy this contract is 5% and the maintenance margin is 5%. Also the trading hours. Okay, so next we have the FX CFD. Okay, when we buy or sell or trade FX, right? Okay, we are referring to the base currency. Okay, so an opposite transaction takes place, right? Is the term currency. Okay, let's use pound. Okay, for this situation, right? Pound USD, right? Pound is the base currency and USD is the term currency. Okay, for example, if we want to buy pound dollar, right? Okay, so what we are doing, right, is we are actually buying pound and we are selling the dollar. We are hoping that pound increases and the dollar weaken. Okay, so how you can understand these codes, right? Assuming that the pound dollar is 1.3, right? Okay, this means that $1, one pound can be exchanged for 1.3 USD. Okay, and when pound dollar is 1.45, right? This means that 1 pound can be traded for 1.45 USD. Based on this quotation, right, the profit and loss will be reflected in the term currency. So, right, if we are in a long position for pound dollar, then we want pound to strengthen and we want the dollar to be weakened. Okay, when you hold a FX CFD position overnight, 5 a.m. for daylight saving and 6 a.m. for non-daylight saving, the position will gain or lose the swap points. The gain or loss is due to the interest rate differential between the currency bought and sold. So interest is earned on the currency bought, while interest is paid on the currency sold. The swap point gain or loss will be credited or debited from your CFD account as the swap points adjustment. Based on our platform, right, we are able to access to more than 30 major global forex pair. Okay, it tracks the performance of the underlying spot forex. The margin is as low as 5%, which also means 20 times leverage. And the base contract, right, is $10,000, which is the base currency. Okay, moving on is the commission. Commission is only applicable, right, when you open and close a CFD position. Okay, when we enter a position, right, we are charged commission. And when we close a position, right, we are also charged commission. Okay, commission for equity CFDs, right, are charged based on the total contract value of the CFD. Okay, do note that different country counters, right, have different commission fees. Do check our website to know more on the particular counter's commission. Equity CFD traded within the same day of the same counter, okay, will be charged based on an algorithmic basis, which also means that the collective commission is charged based on the total value of the day transaction instead of separating the commission from each transaction. Okay, so for commodities and indices CFD, right, they are charged based on per site per contract basis, and commission is not applicable for FX. Okay, based on my past few webinars, right, okay, quite a number of people asking me on commission, and this can be found on our website. Okay, let me show you how to read it. So how can you count our commission? Okay, so the top picture, right, is based on the US equities or US equities CFD. The total commission you will need to pay per entry, right, is 0.18% of the total contract value. However, right, if your total commission is under $15 USD, then we will charge you $15. Okay, assuming that you enter a trade today, okay, and your total commission for the trade, right, is $12. And since $12, right, is under $15, right, so we will charge you $15. However, right, if it's $16, right, then we'll stick with 16. Okay, so for indices, like the Wall Street Index, is quite simple. Per site, $2. If you enter 4, means you will pay $4. Do note that different countries have different commission charge, and also different indices have different charging rates. So you can see our website, right, to know more about it. Okay, now let's dive deeper into financing charge. When you hold a CFD position overnight, right, then you'll be subjected to this thing called overnight financing charges. Okay, this is accrued on a daily basis and will only be realized upon contract rollover or liquidation of CFD positions. So one common question, if I open a position today and close today, do I have to pay the financing fee? Okay, remember that I said that you have to hold pass overnight, then you'll be subjected to the financing fee. Okay, overnight doesn't mean 12 a.m., but it means hold pass after the market close. So if we open and close the position within the same trade day, right, then there will be no financing charges. Okay, the financing charges is only applicable, right, if you hold after the market close. For example, the US market, okay, if we open a position at 10 p.m., or maybe we open a position at 11 p.m., right, and we close at 1 a.m. today, okay, then there will be no financing charge for this situation. So how do you calculate the financing charge? So this is the formula to calculate the financing charges, okay? The market value, okay? So market value, right, of the closing price multiplied by the rate divided by 365. So why do we need to divide by 365? Because long and short financing charges, right, are charged based on per annum. And it's also not fair for you. It's also not fair if you hold for 1 week and then we charge you per annum. So to be fair, right, we will charge based on how many days you hold. Okay. So the orange box, right, is where you can find the market value. And do note that we must see based on the closing price of the market value. And the green box, right, is where you can find the financing charges. Okay, so financing charge is charged based on a daily basis of the closing price. Okay, assuming, right, we were to long one CFD and close it on the third day. Okay, so the day one, right, the closing price is $1,000. Day two, the closing price is $1,200, and day three, right, you liquidate it. So you can see at the bottom, right, that is the formula we use to count the overall financing charge. Okay, you do not need to add the day three financing charge because you did not hold pass overnight, and this is the calculation. So how can we use CFD? Actually, there are many ways to trade on CFD depending on the strategy and your goal and what you want to achieve at the end of the day. Some people buy or sell and hold. Some people use the scalping strategy, and some people use a self-developed trading strategy. So the first strategy, right, is pretty much like the apple tree examples. When you buy or sell and hold, reason being is because, right, it will cost lesser capital outlay, and we will be able to attain a higher exposure and definitely a more diversified portfolio. Or we plan to get dividend or capital appreciation just like the apple tree. Okay, for us to buy and hold is because we believe that the counter will do well. For us to sell and hold, right, is we believe that the counter will underperform. Next strategy is scalping. It's mainly for day trading. Okay, so what these people do, right, is they will monitor the chart, and when there's a given opportunity, right, then they will close the position and earn off small price changes. For example, let's say you enter a stock at $41.5. Okay, 5 minutes later, right, the stock becomes 41.55. So the scalpers, right, will actually take profit and earn that 0.05 per share, and they will do it over and over again and slowly stacking their profit. But in order for you to scalp, right, you must be really very good at your technical analysis. Some traders have developed their own unique strategies over time, and then again, this is based on their own strategy. Okay, it may be a mixture of indicators. They monitor the stock closely and looking at the indicators like candlesticks, for example, or maybe to see if there's any head and shoulder pattern, or maybe cups and handle. Okay, some people uses the moving average and also support and resistance to help them make decision when it comes to trading. So if you were to Google technical analysis, right, you'll probably see some chart, right, that is very complicated and have a lot of different indicators. Personally, I use a mixture of a few indicators, not just candlesticks, but moving average, support and resistance, and demand and supply, before I decide that if I should go on with this trade. Okay, then again, right, all these different indicators, right, are based on your strategy and your liking. Because if you like it, then you could use it more often. If you don't like it, then there's no point forcing yourself to use it. Okay, and ultimately, right, is hedging. Then again, at the end of the day, right, we must see what is most suitable for yourself and best method for yourself. Okay, so hedging, right, is a strategy used by some people. Okay, hedging allows you to hedge against negative events, for example, earning report. If you're actively trading, right, you would already know that when there's a earning report day, right, then they may increase the volume of the stock. Usually when the earnings is really, really good, the stock will fly high. Okay, however, right, if the earning is bad, right, then investors will start losing their trust in the company and start dumping it. Okay, and also we have news like COVID or news like war. Okay, if you remember sometime in March 2020, right, there was a huge price drop. Okay, and for war, right, okay, that because war will cause a lot of fear in the market. Okay, so this will actually cause things to drop in prices lah. Okay, so hedging is like an insurance. Okay, you're protecting is protecting you against the unforeseen circumstances. If the market goes against you, you do not need to worry because you already hedged your position and you hedge it against it. Okay, so sometimes you may even be able to profit out of it. Okay, so hedging, right, can be established by establishing opposite positions. Okay, there's two types of instruments to use: equities or world indices or inverse ETF. If we were to hedge fully, right, then we can establish an opposite position for the same counter and same equities. Same counter and same quantities. If we were to hedge partially, right, it means that we are establishing an opposite position in correlated instruments like STI. Indices are a good hedge against a portfolio of index-linked stocks. Alternatively, you can hedge with inverse CFD. Not necessary you can only hedge by taking on opposite positions. Okay, you can also hedge your portfolio by buying inverse ETF, such that when the prices are falling, right, the inverted ETF will go up. Okay, so an example of the inverse ETF, right, is like SQQQ, where it tracks the Nasdaq 100, right, which is heavily weighted towards technology and telecommunication stocks. Okay, such that when the Nasdaq goes down in direction, right, okay, the SQQQ will go up in direction. Okay, so this is based on a fully hedge. Okay, assuming, right, you have long 100 stocks at $23 in your stock account, and we know that something bad is going to happen and we decided to hedge it fully. For example, we know that earning report is coming and this counter, we expect that it will do badly, and for some reason we do not wish to liquidate our position in the stocks account. Okay, so what we can do, right, is we can establish a hedge fully positions, okay, where it goes opposite positions for the same counter and same quantities. Okay, we know that when the stock do well, right, we will not be affected. Okay, because no matter what, when the stock goes up, okay, my CFD will goes down, so in a way we are net off, we are okay. Okay, however, right, if the stock goes down, right, and it goes down to $21, our stocks account will be negative $2,000, but for our CFD, right, we'll be profiting $2,000. And then if you were to net it off, right, we are still okay. So zero profit and zero loss. Same thing, like the example I gave earlier on, if the stock goes well, and same thing, we will still net it off at $0. Okay, not necessarily, right, that we need to have a position before we hedge, or rather hedging against the negative news. Okay, we can hedge against inflation. Okay, let's use oil CFD as an example. So in this example, right, if you want to hedge against inflation, or maybe you anticipate that the price of oil, right, will continue to increase. So if oil prices increases, right, means your day-to-day expenses will increase, and you do not want to be affected by the oil prices. So what you can do, right, is you long some crude oil CFD as you expect the oil prices to increase, such that, right, if the oil prices actually increase, right, you can actually get paid off, and you could possibly get some gains out of it. And you can use these gains, right, to net off, or rather offset your petrol prices or your day-to-day expenses. However, right, if the price for oil goes down, right, it's also okay because you will not get affected that much, because now that you'll be able to buy oil at a cheaper rate. So whatever the direction of the oil prices goes, right, you do not need to worry about the inflation, the oil prices. So this is just based on my own personal take on investing, and I think it will be good for us to learn. Okay, so before entering a trade, right, we should always have a stop loss. A stop loss is an order, right, that automatically cuts your position, right, once your trade hit a certain predetermined criteria. And this is very important. It's very, very important for you to place a stop loss. Okay, because that when the market goes against you, right, you will not lose that much, and you already expected that loss already. Okay, I have seen many investors, right, or rather I have seen investors forgetting to place their stop loss, and then they just go to sleep, and the next morning, right, when they wake up, right, they lose quite a bit of money, and there's nothing they can do out of it because they didn't place their stop loss. So stop loss is a very important thing. So always place a stop loss, right, before entering the trade. Okay, and the next one is position size being too big. Okay, when they see the counter moves a bit, right, your account will increase a lot. Okay, and then for some people, right, when they place a too big of a position, right, they cannot focus on their job, or they cannot sleep at night. And even when they are driving, right, they also focus on the counter. They hope that the counter will continue to go up. Okay, so if you are buying too big, such that when the market goes against you, right, okay, you may potentially wipe out your account lah. And the bad thing about it, right, is you wiped out your account and then you never concentrate during your work, and your mood wouldn't be so good also. So if let's say you ever feel that your position size is too big, right, then do not buy until so big lah. You do not invest what you cannot lose lah. And the next one is emotional. Okay, some investors get too emotional. For example, FOMO, where they have the fear of missing out. Okay, like for example, my friend say this stock very good, buy. Never research, you just buy. Okay, or maybe or maybe another situation is this particular counter, right, it goes up by 10% today, and then because you FOMO, because you never buy the 10%, what, then you think that you should buy. Then when you buy it already, right, the market goes against you, and you're stuck in that position already. Okay, so whatever it is, right, never ever FOMO, because there are many of opportunities out there, right? Even if you miss one, then never mind, because there's gonna be another opportunity out there. So don't ever FOMO into trading lah, and also greed. So if let's say, right, your strategy tells you that you already hit your target already, okay, then you must take profit. Okay. However, I have seen some people, right, because they refuse to take the profit, right, and they just keep buying, keep buying, keep buying, keep buying, and they keep stacking on their buy. Okay, so their position size get bigger and bigger and bigger and bigger. And because of this greed, right, one day, right, the market goes against you, right, and then they lost all their profit, and they even lost money. And they are supposed to be profiting, but then they actually lost money. Okay, so never ever get too emotional in the stock market lah. And also the next thing, right, is over trading. So over trading, right, is to a point, right, where you may think that it's like gambling. So you just tikam buy or sell. Okay. There are also some situation, right, where investors are having a bad day and then they start to revenge trade. So when you gotten a stop loss, right, then never mind, he buy in again. When he gotten another stop loss, right, never mind, he buy again. So when he gotten stop loss again, never mind, buy it again. Then this ultimately, right, becomes like gambling. Okay. Because when you lose, right, never mind, you double up. Okay. So when you double and double and double and you keep losing, right, then end up you'll lose a lot of money. So always remember that, right, it's good to take a break. If you have gotten like maybe 3 or 4 or maybe 5 stop loss for the day, right, then you just wait for another day to trade again, because there's always opportunity. You do not need to um insist that you want to trade, you want to earn back, you want to earn back your money. So whenever you have this intention already, right, means it's starting to be like gambling and it's over trading already. So never ever over trade in the market. Okay. So like I said before, leverage is a double-edged sword. You can multiply your money very quickly, but when the market goes against you, right, then you may potentially lose some of your capital. So only invest in what you are comfortable losing. Okay, this is the end of my personal take on investing. Okay. So for our existing customers, right, you may create a CFD account by clicking on account management, CFD, and online account opening. Okay, so for our new customers, right, okay, you may create an account via poems.com.sg and you can follow the steps. Alternatively, you can call your TR or walk into a PhillipCapital, Phillips Investor Center. We have quite a few outlets. You can check the website. Okay, you can find more in our website, or you can just scan this QR code to create an account with us. Yeah, give you some time to scan the QR code. Okay. Okay. So you may also fund your CFD account, right, via internal transfer, which is to click on account management, stocks, online form, withdrawal form, enter the amount that you want to withdraw, okay, and click on to transfer into CFD account for the purpose of CFD trading. Or you can pay now transfer, and you can watch the tutorial, right, on how to do this pay now transfer. Okay, so for direct funding into CFD account, right, okay, you have to add the CFD at the back. Okay, so anyways, right, for those of you who are not aware of it, right, we have recently launched our new app and it's super mobile friendly. Okay, we have refreshed, revamped, and redesigned the look of it. Okay, I would say that the charting wise, right, is more user friendly. And later I'll share an advantage of it, which is I think is very useful and good lah. Okay, you can scan the QR code to download Poems 3. Let me give you some time to scan it. Okay, so one advantage of Mobile Tree, right, is we provide you this thing called community group. And this community group, right, is managed by our in-house experts. Okay, you can connect and share investment tips, right, with like-minded investors. So you can join our group to learn more about it. Okay, so you can get insights from our in-house analysts and a wide range of educational materials ranging from webinars, article, and many more to broaden your perspective of the investment world. Okay, so do download Poem Street and join our community. I highly recommend you to join our different community group, because I personally have learned quite a bit from there already. Okay, so moving on, this is the Q&A time, okay? Do you have any questions to ask? Give me some time to read through the questions being asked. Okay, okay, so someone asked, will the slide be made available? The webinar was quite fast. Okay, we do not have the slides. We will not be sharing the slides, but then we will be sharing the recording lah. And the recording will be found in our website, and it'll be only available next Monday. Okay, so someone asked, right, should I invest in equities or CFD? Okay, so this, right, is based on your own strategy really and what you want to achieve out of it. It depends on how long your time horizon is. Okay, and if you are someone who closely monitor and are you someone, right, who closely monitor the stock market movement? Because if you don't monitor, right, and you just wish to leave it there and for a few weeks, for a few months or a few years, right, then equities is better because you will not be subjected to financing charges. And if the market goes against you, right, you will not be subjected to margin call. Then again, this is depending on your own strategy. CFD is good that you can be taking advantage of the leveraging and you can participate in both long and short position. But do note that leverage is a powerful tool, okay? But do not over leverage on it lah. So then again, it's your up to you whether you want to choose equities or CFD. Yeah. But personally, I would say that if you're a short-term trader, right, maybe you can venture into CFD because CFD allows you to gain exposure or rather to hedge your positions out there. Okay, I don't think I see any more questions. And yeah, okay. So if let's say you have any questions that you wish to know or today you don't want to ask, right? Then you can actually look up into our website to read up more about it. Or alternatively, you can either contact your TR or call in the hotline lah. Then we will assist you further on it lah. So for more information, right, you can view our website on CFD and you can read our info sheet to find out more details about it. Or you can always call in to check with us lah. Thank you so much for attending today. So I'll see you all for the next webinar. Thank you.